I'm not turning on the. Hi there, welcome one and all to another live webinar with Phillip Futures. This is Sri, and I'm your facilitator of the day. Once again, we are very happy to host you in our first live webinar for the new year. So, hope everyone had a wonderful new year and are here to learn something exciting from our guest speaker, Wan Zuhao, who is the Chief Technical Officer for Synergy Link Capital. Zuhao will be discussing the Ethereum landscape in his topic for today, understanding Ethereum, and what are the key talking points for today. We will be discussing the Ethereum landscape and how it is different from Bitcoin. And Zuhao will also share some details, which is very important, about the future developments of Ethereum and its potential implications. Stay tuned to gain a good understanding of the Ethereum landscape. Zuhao will also touch on the Ethereum 2.0 roadmap as well as Ethereum's triple halving event and its implications. What does this mean if you are observing Ethereum and the prices of Ethereum? And of course, what are the different vehicles of Ethereum that investors should be aware of? All right, before I hand the reins over to Zuhao, can I just do a quick sound check if you can hear me loud and clear? Please type yes in the question box, which can be found somewhere at the bottom of your control panel. So you hit your control panel, it should be somewhere at the bottom. Let me know if you can hear me loud and clear. All right, thank you, Ming, for confirming that you can hear me loud and clear. The rest of our wonderful audience, can you hear me? Just head down to the question box. This way, if along the way, if you have any questions, you can. Thank you, Srini. Thank you, Yen. All right, so Zuhao, if you're all set to go, I can hand the reins over to you now.
Sure. Thank you, Sri. Thank you, everyone, for joining us tonight. And Happy New Year to all of you. And thank you for tuning in to allow me to share some of my thoughts about Ethereum. And throughout this sharing session, if you, like Sri said, if you have any questions, you can type in the chat box, right? We should have some time left at the end of the sharing, and I'll be answering some of the questions then. Okay, please note that everything we talk about here today is for informational and hopefully entertaining purpose only. There are substantial risks involved in trading, especially in the crazy cryptocurrency market. I'm sure you all know. So please do your own research and fully understand the risks before putting any real money into the market. Now, before we get started, I would like to give you some introduction to my companies and myself. Synergy Link Capital is a Singapore-based proprietary trading firm. Our founders were mostly from the prop trading desks of the major investment banks. Most of them started their career on the exchange trading floor before trading became electronic. So combined, we have a lot of market experience as we have gone through multiple cycles of booms and busts. That gives us a very deep understanding of risk management. And I believe this is our biggest edge in the market. So last year, the partners of Synergy decided to incorporate a new fintech company called Inspirante Trading Solutions. So our purpose is to keep Synergy entirely focused on trading, and we will use this new fintech company as the vehicle to expand the business into, for example, providing solutions, research, and various training programs and sharing sessions like today. About myself, I came from a computer science background and joined Synergy about 6 years ago. Now I am the partner and director of both Synergy and Inspirante Trading Solutions. So at Synergy side, I trade mainly global macro and volatility arbitrage portfolios. And at Inspirante side, I frequently conduct training courses and webinars for various exchanges and brokers. I'm also the author of a biweekly market commentary that CME published on their website. It is called fresh from the trading room, which I discuss the latest market views and actionable trade ideas regularly. So this commentary is meant for retail traders. So you are more than welcome to subscribe for free at the link below. Okay, now let's get started. I will turn off the camera and let's focus on the slides. Okay, today I'll be talking about Ethereum. All right, many people think that Ethereum is just another cryptocurrency like Bitcoin that was invented a few years later than Bitcoin. And hopefully after the sharing today, you will understand that this is not the case. And there is so much more to the story of Ethereum. In addition to talking about what Ethereum is today, I'm even more excited to share with you what Ethereum is going to be in the future. That is the Ethereum 2.0 roadmap. And then with the understanding of how Ethereum came to its place today and where it is heading in the future, we will take a look at the resulting demand and supply dynamics, which people sometimes refer to as the triple halving events, which is believed to be very bullish on the mid to long-term price actions of Ether. And finally, we will be talking about how to use CME futures to have exposure in Ethereum and some of the risk management measures. Now, I'll try to focus on the big pictures for everyone to have a foundational understanding of Ethereum instead of spending too much time on the technical details. In addition, my perspective is more of a macro investor, excited about the potentials of this technology, looking through the lens of a commodity analysis where I try to understand the demand and supply dynamics and their implications. So again, not so much on the technical side. So first thing first, what is Ethereum? To call Ethereum a cryptocurrency is actually a misnomer. Ethereum is not a cryptocurrency like Bitcoin. Ethereum is a platform. So a platform is something like an operating system. For example, your Windows PC or your iOS on your iPhone, where other software programs can be run. So according to Ethereum's own description, it is a technology that is home to digital money, global payments, and applications. I know it is still a little bit vague. So to put it even more simply, we can understand Ethereum to be a decentralized open source blockchain that can run applications called the smart contracts. And we will get to the smart contracts in a short while. What people normally mean when they talk about Ethereum, especially with regard to the price, they are actually referring to Ether. Ether or ETH is the native cryptocurrency of the Ethereum platform. Its existence is for one specific purpose, to facilitate the decentralized applications on Ethereum network. How so? As we all know, in order to run any program or any application on any kind of platform, we need to spend certain computational resources. That's why when you get a faster CPU or a higher RAM PC, many of the programs run faster. Now, on Ethereum platform, for the applications to run, they also need to consume computational resources, whether it's simple if this then that kind of service or more complex application like an exchange. So they differ in complexity and the resources needed. So Ether is therefore designed to facilitate such applications on the Ethereum network. So we can think of Ether as the lifeblood of Ethereum. To quantify the cost of such computational resources on the Ethereum network, we have something called the gas fee. It is basically a list of different computational operations and their corresponding costs. Therefore, users pay gas fees to compensate for the computational energy required to process and validate their transactions on the network. So think of it as the gasoline that we pump into our cars. In order for us to drive from one place to another, and the further we go, the more gasoline we will need. And gas fees are quoted in ETH, and it can fluctuate with supply and demand for processing power on the network. In other words, when the demand for processing power is high and the supply is low, the price of gas goes up. Now, here is a chart showing the median transaction gas price versus the ether price. We can see that since Q3 of 2020, when the entire crypto space started to launch higher, there was a period of gas fee spikes. And at that time, the ether was just broke $300. And subsequently, in the middle of last year, when ether broke the previous high in 2018 and continued to go above $1,000, we saw gas price went up again. And clearly, under the current setup, gas price is influenced by the overall interest and demand in the Ethereum network. Now, let's talk about smart contracts. As we saw just now, one of the most important features of the Ethereum platform is that it's a blockchain for running smart contracts. These so-called smart contracts are fundamental building blocks of the Ethereum applications. Smart contract is a fancy name for computer programs running on the Ethereum blockchain. Computer programs are exactly what they are. These smart contracts are created using a programming language called Solidity, just like some of the more general purpose languages you might have heard of, like C++ or Java or Python. Even though they are all just programs, computer programs, most of the smart contracts are to digitize some kind of agreements by turning the terms of the agreement into code that automatically executes when these terms are met. Hence, the fancy name smart contracts. Now, a traditional contract or a agreement would be like this. Say you and I take a bet on whether the S&P 500 index will close above or below 5,000 points by the end of this year. So if it's above, if it's 5,000 or above, I win and you give me $1. And if it's below 5,000, you win and I give you $1. Now, when the time comes at the closing bell of the last trading day of 2022, we will certainly know the outcomes of this bet. We simply look at the closing price of the S&P 500 of that day. And there can be only two possible outcomes, either I win or you win. However, there's no guarantee that either party is going to fulfill the obligation, which is to pay the $1 if he loses. So in addition to having this agreement between us, we also need to be able to trust each other to fulfill the agreement or to find a third party or other kind of enforcement mechanism. So this is an example of a traditional non-smart contract. A smart contract, on the other hand, can digitize the terms and automatically execute it when the terms are met. For example, we could create a smart contract that checks the S&P 500 closing price on the last trading day. And if it's below 5,000, $1 will be immediately deducted from my wallet and transferred to yours. Of course, there are other conditions to be met. For example, the smart contract will have to make sure that both parties have at least $1 in their wallet in order to make the payment. So all these are without the need to have the trust between the parties involved. Now, from this silly example, we can already see many benefits of the smart contracts. First and foremost, one of the most significant benefits of smart contract is that the outcome is automatically executed when the contract conditions are realized. Now, we don't have to wait for a human to execute the result, which means smart contracts remove the need for trust. Secondly, the outcome of such execution is predictable. It is because for as much as possible, the human factor is removed from the contract's execution because it's based on computer codes. So there will not be different interpretations, hence unpredictable outcomes like the traditional contracts. The deterministic predictability also means that since it's just a piece of computer code, if you give the same input, which is given the same circumstances, the smart contract will always produce the exact same result. The third benefit of smart contract is that it's useful for auditing and tracking. The Ethereum smart contracts are on a public blockchain, which means anyone can instantly track asset transfers and other related information. And this information goes way back to the beginning of its existence. So no one can tamper with or alter the public record once it's validated and becomes part of the blockchain. The ability to keep public record doesn't mean that smart contracts on Ethereum will compromise your privacy. On the contrary, the smart contracts actually help to protect our privacy. It is because Ethereum is a pseudonymous network, which means all of your transactions are only publicly tied to a cryptographic address, but not your identity. Last but not least, there's great transparency for Ethereum smart contracts. Ethereum itself is open source, and when you are interacting with the smart contract, you can always check exactly what is being coded as the terms. So anyone can scrutinize the contracts to make sure it does and only does what it's supposed to do. And public transparency helps to harden the security of the network, because if there are any bugs, they usually can be spotted and fixed early before much damage is done. Now, after understanding the major benefits of smart contracts running on Ethereum as compared to traditional contracts, let's take a look at some of the specific use cases for smart contracts. One of the most important use cases for smart contracts are the stablecoins, such as Tether, USD Coin, DAI, and so on. Now, stablecoins are the on and off ramps that bridges between the fiat system and the crypto system. The stablecoins themselves are also cryptos, but by design, they do not have the volatility and should stay at a fixed dollar value. So stablecoins are used to facilitate people to move in and out of different cryptocurrencies without the need to deal with the fiat every time that happens. Now, there are various mechanisms that each stablecoin use to ensure their values are indeed stable. They could be backed by traditional fiat currency or cash equivalent, such as the USD coin, or they could be backed by cryptocurrencies, such as DAI, or they could be backed just by algorithms that alter the total supply of stablecoins to maintain its value peg. Another very hot use case is the NFTs, non-fungible tokens. I'm sure you've heard a lot of it being mentioned before on the news. NFTs are not just for digital arts or collectibles. They can actually be used to represent ownership of any unique asset, whether it's in the digital or in the physical realm. The benefits of Ethereum network and the smart contracts makes it possible for the NFTs to work. For example, the transaction history and token metadata is publicly verifiable to prove the ownership. The smart contracts also make decentralized exchange possible. The DEX are open marketplaces for Ether and other tokens, so they connect buyers and sellers directly, so you don't have to have a centralized exchange to hold your funds or take custody of your coins. And not only can crypto exchanges be decentralized, even insurance can be decentralized with smart contracts. The idea is that when certain events get triggered, the claim process and payout can automatically happen. And lastly, Ethereum smart contracts enable anyone to build their own decentralized applications and issue their own tokens for the specific app. Now, the list goes on. Ethereum's smart contract functionality truly makes many things possible. Although many of the use cases, especially those in decentralized finance, are still experimental, as this is something that none of us had ever seen or done before. But one thing we know for sure is that there are so many talented developers all over the world working on it now, and this space is advancing at an unbelievably fast speed. Now, we can already see how the technology is potentially benefiting the users. Now, we also look at what is the implication for us investors. When we are trying to understand the impact of such revolutionary technologies, it helps to first understand this term, the network effect. What the network effect describes is that the value a user derives from a network depends on the number of users in that network. And network effects are typically positive, meaning that as more users join the same network, it creates more value to the individual users. Now, there are two effects to describe the adoption by an additional user. The total effect means an increase in the value to all other users, and the marginal effect means the non-users are more motivated to join the network now. Some of the very well-known products that enjoy the network effect are like telephones, the internet, social media like Facebook, and of course, cryptocurrencies like Bitcoin and Ethereum platform. Imagine when telephone was first invented, having a phone line isn't very useful because most of your families and friends do not have that yet. So you have no one to call, which means the value of the telephone network is still pretty low for you. Only until everyone joins the network and has a phone line, then it becomes very valuable to the users. Same goes for Facebook and same goes for the Ethereum platform. Last year, Goldman Sachs published this research paper on cryptocurrency valuations and their network size. We can see that not only Bitcoin and Ether, but many other notable cryptocurrencies all fit in this model very well. Bitcoin and Ether are just two of the earliest and the largest by network size and market capitalization. Now, from this more updated chart, we can see the growth in Ethereum users has been truly staggering. It increased almost 6 times since the beginning of 2018 and shows no signs of slowing down yet. Now, so far we have spent some time trying to understand what Ethereum is, the unique benefits of the smart contracts, and the exciting possibilities in the future. However, it doesn't mean that it's all perfect with Ethereum and that it doesn't need to change anymore to continue its rapid growth. Like many new and revolutionary technologies, Ethereum also has gone through experiments, trials, and errors. So even today, as the second largest crypto market, Ethereum is still has some notable weaknesses and issues that need to be improved upon. The biggest problem currently faced by Ethereum is the network congestion. High demand has been driving up transaction fees, which means Ethereum network becomes more expensive to use for the average user. Remember the gas fee spikes we saw a while ago. A transaction cost can become a roadblock for bigger adoption, and Ethereum's transaction cost is determined by the demand and supply of computer resources. Therefore, it is vitally important to reduce the network congestion and bring down the cost. Now, the second problem is also related to high demand of Ethereum network. As the blockchain grows at a very rapid rate, it becomes harder and harder to run an Ethereum client because the disk space needed is also growing very fast. This will only get harder when we try to scale the network, which means more participants, more transactions, thus even bigger space needed to run a client node. Lastly, the current underlying proof of work consensus algorithm that is used by Ethereum and Bitcoin that keeps the network secure and decentralized has some big environmental impact. It uses too much computing power, hence electricity. As many of you may have heard, mining these kind of proof of work based cryptos are extremely energy intensive on top of the need for very powerful computer hardware. So these are the three major problems faced by Ethereum now, and the roadblocks for Ethereum to have even better scalability, security, and at the same time, less carbon footprint. Like many other software technologies nowadays, Ethereum is also evolving and improving incrementally over time. There is a constant effort in the research and development, and eventually upgrades are done to address all these problems. So what is commonly known as the Ethereum 2.0 is such a set of upgrades to solve these few biggest problems we've mentioned just now. There's something called the scalability trilemma. What it means is that among the three qualities, right, which is scalability, security, and decentralization, achieving two is usually easy, but at the expense of the third. To achieve all three is extremely difficult and challenging. For example, a network can be very scalable and secure, but it will most likely have to compromise on the decentralization. Or if a network is scalable and decentralized, its security is going to face some big challenges. Ethereum's vision is to use very well-designed technology and incentive systems to try to solve the scalability trilemma. This is the main purpose of the Ethereum 2.0 upgrades. Now that the technology is ready, these upgrades will re-architect Ethereum to make it more scalable, secure, and sustainable, which is beneficial for existing users and will entice new ones. And at the same time, it is preserving Ethereum's core value of decentralization. And these upgrades and improvements will happen incrementally over time, and a rough roadmap shows it in 3 phases. The first phase is already live, and the next 2 are expected to go live in the next 24 months or so. When the 3 phases are fully live and Ethereum 2.0 upgrades has been completed, these are the improvements we will see. First of all, Ethereum network will be able to handle more transactions per second without increasing the size of the nodes in the network. It will reduce the network congestions and improve speed. The shard chain also makes nodes more lightweight, allowing Ethereum to scale and remain decentralized. Secondly, Ethereum will transit from a proof of work to proof of stake, which means the Ethereum protocol has a greater disincentive against attacks. It is because the validators who secure the network must stake significant amount of Ether into the protocol. If they try and attack the network, the protocol can automatically destroy the Ether. And this is not possible with the traditional proof of work algorithm. In addition, staking means that users don't need to invest in high-end hardware to do mining and run an Ethereum node anymore. It can encourage more people to become validators, hence increase the network security and decentralization. And finally, the proof of stake mechanism makes Ethereum no longer energy intensive like the Bitcoin network, because it is now secured by Ether staked, not by computing power anymore. Now, on top of the Ethereum 2.0 upgrades, there is another very significant change to the Ethereum network recently. It is commonly known as the EIP 1559. It basically changed how transaction fees work. Without getting too technical about this proposal, we just need to understand that the most important implication is that it introduced a burn feature and takes a portion of the transaction fees out of circulation. So what it means is that it creates a constant deflationary pressure on the Ethereum network by reducing the Ether supply. Just like Bitcoin's halving that you may have heard of, that roughly every 4 years, the rate at which new Bitcoins are released into circulation is cut in half. Now, from this chart, we can see that since August last year, when EIP 1559 went live, so far more than 1.3 million Ether, or roughly 4.3 billion US dollar, has been burned. So effectively, EIP 1559 is reducing the supply and the selling pressure of Ether. Now, back to the proof of stake. We can see here that since end of 2020, almost 9 million Ether has been staked by the Ethereum network validators. Again, this portion of the Ether are removed from circulation. Thirdly, as more and more decentralized finance applications were developed and started to run on the Ethereum network, more Ethers are being locked in these applications for either staking or for loans, for deposits, or being used for any other financial actions. Here we can see that more than 1/4 of the total supply of Ether is held in various smart contracts. So what we meant by Ethereum's triple halving event is that all these different factors all contribute towards a massive reduction of Ether supply in circulation, hence reducing the selling pressure. At the same time, don't forget the demand is still growing exponentially with wider adoption, more decentralized applications, and so on. So this demand and supply mismatch is incredibly bullish for the long-term price for Ether, like any other financial asset that has reduced supply together with ever-increasing demand. Now, this chart shows the past few halving cycles of Bitcoin. You can see that each is followed by a huge price advances. And finally, if we look at the chart of Ether to Bitcoin ratio, it has broken out from a massive rounding bottom last year. And after a few months of consolidation, it is breaking out again. This means that in the next, I would say 6 to 12 months, Ether is likely to continue outperforming Bitcoin. Now, finally, for small investors like us to start participating in this exciting technology, whether it's short-term trading or long-term investing, CME futures on Ether is an excellent instrument, especially if you don't want to deal with the complexity of buying and storing the actual Ether coin and facing the non-negligible counterparty and regulatory risks involved with the online crypto exchanges. CME's micro Ether future is only 0.1 Ether per contract, which means it's a very, very small size contract. Last time I checked on CME's website, the margin is just above $100 for one contract. And it is financially settled, which means you don't have to worry about the physical delivery, but you can still participate in the price actions. Now, before we wrap up, I would like to talk about some of the risks involved in trading or investing in Ether. First and foremost, understand that cryptocurrency is still a wild west in terms of regulations. So the nature of decentralization means that there are all kinds of online crypto exchanges. Some of them are very sketchy, if not outright scams. You have substantial counterparty risk when you trade on these platforms because for most of them, you don't actually own the cryptos you bought. These crypto exchanges own them. So to mitigate the counterparty risk, I would recommend the following. You can choose to participate via CME futures. This is my personal preference because it has virtually no counterparty risk. Because you are trading a regulated futures product on the biggest derivative exchange in the world. Or if you prefer to trade on the crypto exchanges, choose the reputable ones, but understand that there are still risks and uncertainties. I'm sure you all know about Binance. They will cease to operate in Singapore pretty soon. If you prefer to hold cryptos for long-term investment, I recommend that after you bought the coins, immediately move them offline into a cold wallet. By doing this, then you actually own the digital asset. Now, the second risk is the volatility risk. Crypto is still a highly volatile financial asset, so please be very careful not to take high leverages, especially on some of the crypto exchanges. Taking high leverage to trade a high vol asset, to me, is a sure way to ruin. And last but most importantly, only risk what you can afford to lose. And that concludes the sharing on Ethereum today. And I hope you find it useful. If you have any questions, please go ahead. Thank you.
All right, thank you so much for that enlightening webinar and sharing of content about the Ethereum landscape as well as the differences with Bitcoin. Zuhao, while we wait for the rest of the questions from our members of the audience, dear members of the audience, you can head down to the question box to type your questions in so that we can gain some insights from our speaker, Wan Zuhao. All right, we have one question in the question box. Zuhao, with sharding in place, transactions will be batched up, which would reduce the demand for Ether. So what's your view on this?
Sorry, with sharding in place, I didn't get the second part.
Okay, with sharding in place, transactions will be batched up, which will mean which would reduce the demand for Ether. So transactions being batched up, it would reduce the demand for Ether. What's your view on this?
Okay. My view is that yes, there are certain factors that supposedly will so-called reduce the demand for Ether. But to me, the overweighing factor is like what I have described, the three very important factors that takes Ether out of circulation. right? So I believe the supply side of the story is going to affect the Ether price a lot more than some slight reduction in Ether demand. Right, because someone actually, by the way, if you are interested, you can Google this Ethereum triple halving event. Someone wrote a very comprehensive article on it. So by his estimation, right, when the Ethereum 2.0 and everything is fully in place, as much as, if I remember correctly, 70-80% of the ether supply would be taken out of circulation. Yeah. So to answer the question, I do agree, but I think the supply side of the story is even plays an even bigger role in the future price of ether. Thank you.
All right, Zuhao, the next question is from Srini. He's asking, are there gas fees linked to the price of Ether?
Are there gas fees linked to the price of ether? Okay, the gas fees are a defined set of costs, right? So if you look at the white paper of Ethereum network, you can see that for each operation, what is the corresponding gas fee? So in that sense, it is not linked to Ether. It's just the gas fees are quoted in Ether, right? And for example, to do this particular operation, right? How many ETH or how many Wei? Wei is the unit they use to measure gas fees, right? How many gigawatt it takes to run this operation, right? So, however, the compete for computational resources in the network, right? For example, if you want your transactions to be quickly validated by the validators, right? You can set a higher gas fee limit, which means you will pay more gas fee to have your transactions validated faster, something like that.
Hey, Zuhao. Okay, you mentioned storing your cryptocurrency, or in this case, Ether, in a cold wallet. What about having it staked in a platform to earn interest? What do you think is the way forward for us today?
Okay, I have to say that compared to traditional financial market now, let's say if we look at whether in US or Singapore, if you save your fiat currency in a bank, it's at most slightly above zero, right? The interest rate. Whereas if you stake or put your cryptocurrency, whether it's Ether or even the stable coins, you can get a pretty decent interest rate of let's say 5-7%, right? But yes, I do agree this is very attractive. You are right, but there is also risks involved, right? So you have to judge for yourself. Is this 5-7% worth the risk worth taking, right? So again, for me, let's say if I don't want to get too technical, I don't want to run as a validator on the network, right? For example, I'm just an investor. I find this I find this ether to be a wonderful macro opportunity. Right? I just want to participate in the price actions without getting into the staking, the details, and all that. Right. So if that is the case, right, I would actually prefer to buy the Ether coin and store in the cold wallet and forget about it until the price is right, then I'll let go. Right? That is from a investor's perspective. But if you are, let's say, a developer, or you are someone who is very passionate about this technology, or you may even develop your own decentralized apps, right? So if that fits you, of course, you can choose to stake your ether to be a validator to earn the whatever reward it is So it really depends on your angle, your investment objective. Thank you.
All right, Zuhao, we have another question. It is not related to what we are discussing today, but it is interesting enough for me to throw it your way. Okay.
Sure.
So, Zheng Yu is asking, are NFTs worth buying? I mean, there's a lot of hype about NFTs. We have a cartoon cat that's like, like
Yeah.
triple or even 10 times its original value. So,
Yeah.
what's your view on NFTs?
Okay. Okay. Let me try to put it. Okay. Let me try to put it this way. What we are dealing now is the forefront of something very new, very revolutionary, right? The let's say the Web 3.0, the NFTs, the metaverse, and so on. All these buzzwords, right? It does not. Okay. First of all, I would think that most of the, let's say, the NFTs, or a lot of them, is definitely a bubble. It's just like the tulip bubble or the dot-com bubble, right? But it does not mean that out of all these different, let's say you call it NFTs, or even different altcoins, right? All these different new stuff, we don't know for sure that, if all of them is going to die, or out of 100, maybe one or two is going to be the real thing, the unicorn, right? So just imagine back in the dot-com days, right? Any company with a dot-com in their name can see their price went up nonstop, right? But even though they are not making any money, or even though they don't even have a product, but so most of the companies died, right? But it's also from that time, if you happen to be betting on the right companies, right? The Facebooks, the Googles, the Microsoft, and all these, the Amazons, the Nvidias, right? All this is going to be a multi-bagger for you. So it actually, whether you ask me so if you ask me whether NFT is worth buying, I have to say that I don't have an answer. I don't own any of it, and I find it quite. I don't quite get it. I find it very very bubble like, right? But it doesn't mean that eventually there could be something. There could be something that has real world use cases out of it. So my suggestion to let's say when friends ask me about this digital space is always that, first of all, diversify, right? Don't bet your whole net worth on just one picture, right? So first of all, diversify, and second of all, because I'm a trader, right? So everything is always risk management, right? So you only risk what you can afford to lose, right? So let's say if you find this NFT very interesting, even from art perspective, it looks nice to you, right? You don't mind holding it, and your intention is not to, let's say, get rich overnight. Let's say that. And you have some spare cash in terms of, let's say, you have made some money on trading ether, right? Why not just hold it as part of your alternative investment, right? But I would definitely not advise anyone to put a substantial amount in this, because maybe I'm old school, but to me it is still too new, and too many pump and dump schemes, and too many people trying to get rich quickly. This is a typical initial stage of the bubble behavior. Thank you.
All right, so we have another question from Srini. Srini is asking, will the burn feature lead to a drop in price of Ethereum eventually when, say, in future, Ethereum 3.0 is delivered?
Oh, you mean Ethereum 2.0?
Sorry, 3.0.
3.0. Oh, sorry, did you say 2.0 or 3.0? I'm not aware of Ethereum 3.0?
I guess we are looking far into the future and
Into the future.
assessing
All
what
right.
could happen.
Okay. Well, I can't say for sure. But just from a commodity analysis kind of view, right? What you have here is that first of all, if you need to run any kind of decentralized application on Ethereum network, you will need this Ether, right? Because that's the whole point of Ether, is to facilitate these applications. So assume that all these there are a lot more decentralized applications going on, and a lot more demands for running them. Therefore, a lot more demands for this Ether. And then each transaction, it will burn a portion of the fees, right? And I can only imagine that, it doesn't reduce the demand side as much as it reduces the supply of the ethers in circulation. So that is my understanding. I do not think that the burn feature is going to meaningfully so-called lower the price of ether. Thanks.
All right, Zuhao, this is a very key question that's coming out next. I think something that a lot of us are closely monitoring. What is your assessment of Ether being overtaken by other first or second level competitors?
Yeah, that's a good question. It's just like you see, Bitcoin was the very first cryptocurrency, right? So still today, there are a lot of so-called Bitcoin maximalists who thinks that all the other coins are rubbish, right? Only Bitcoin can solve every problem, which I totally don't agree. Right, so I think in this vast digital asset space, there are going to be different technologies, different tokens for different purpose, right? Just like today we have different tech companies for different purpose, right? So Ethereum is just much earlier than some of the later competitors, right? Which I think that the later competitors may very well overtake Ethereum in the future. Okay. But the problem now is that you are basically, again, I'm speaking from an investor's perspective, right? Again, you are basically pushing further out on this risk curve, right? So when we're talking about risk curve, basically, you can imagine a curve like this. At the bottom left-hand side, right? It's the low risk but lower potential return, right? And on the upper right side, it's going to be the super high risk and potentially a very high return kind of asset. Okay, so for example, your cash would be at the lower bottom, your corporate bond or your government bond would be at the lower bottom. But on the other hand, the cryptocurrencies and let's say the VCs and the private equities will be up in the right hand side. Right, so this is a typical risk curve in the financial system. It works for cryptocurrencies as well, right? You have your stable coins, you have your Bitcoins. I think many of you can see that the Bitcoin volatility actually dropped quite a bit recently, right? It's not really going anywhere, right? So the big price moves are actually the altcoins, the new ones, which are further out on the risk curve, right? So ultimately, it's about your risk appetite, right? At which part of the curve you are willing to take a bet. And this comes back to the two things I mentioned just now. First of all, diversify, right? You don't have to putting your whole bet into one thing, right? So you can very well have a mixed portfolio of, let's say, some Ether, some Solana, right? Some Luna, all these. You can construct your own portfolio, right? And I believe it will work much better than if you were to hold one single asset, right? Just like you want to hold a portfolio of stocks and bonds instead of just betting on one single stock, right? So this is one thing, diversification, and secondly is again back to the risk appetite. How much money you're willing to bet on it, and how much you can afford to lose. Right. In terms of Bitcoin and Ethereum, you roughly know the kind of volatility, and you also know that they have gone through quite a few cycles of big booms and busts, right? So they managed to survive quite well. So in that sense, they are relatively safer, right? But further out the risk curve, some of the new coins, they have not, or new technologies, they have not really gone through any of the so-called existential crisis, right? So the chances of losing substantially more on those coins are much larger, right? So that's my answer. I mean, you can choose to any part of the curve. You can have a combination of different coins on that. But I just don't think that given Bitcoin and Ethereum that they are going to get completely replaced one day. I don't think so. I think they will have their place in this whole digital asset ecosystem. Thank you.
Hey Zohao, we have a couple of really interesting questions. If time permits, I'll let you have the pleasure of answering all. The first one that we have is a very interesting one from Srini. He's asking if Ethereum becomes like a very common or key platform, something like Windows, that something that we cannot live without, and it is prevalent all over, prevalent in our life. Will the price of Ethereum dip and become less valued as a result?
I'm not very sure about the value of of Ether, but I'm sure that the volatility is going to get a lot lower, right? As the mass production, and mass adoption happens, right? So last time I heard, I think it was last year or even before that, even some of the central banks in Europe started to issue bonds on Ethereum. Right, so this is just an example of the adoption into mainstream. So when there's a wider and wider adoption of this platform and it becomes so everywhere, right? Ether price can't be, let's say, go up and down 10, 20% a day anymore, right? It just doesn't work that way, right? When something is more and more adopted, the price will be closer and closer to its so-called fair value, whatever that is, right? So to answer that question, I don't have a crystal ball to see whether the price is going up or down, but I'm pretty sure that the bigger the adoption, the more stable the price is going to be. Thank you.
All right, Zuhao, what's your view of Sol taking over Ether? Like, is Sol really a big threat to Ether?
Yeah, this is like I mentioned just now. Solana has its potentials, right? It has some very distinct advantages over the Ethereum network. And during the NFT boom a few months back, Solana was actually at the center of this whole thing. But like I mentioned, it's still very young as compared to Ether, and it hasn't really gone through enough. I would call it market cycles, right? Whether in terms of the price or in terms of the technology, right? So I don't think in the short future, Solana is going to replace Ethereum, but Solana definitely has its place, right? So again, I'm not against. Actually, I prefer to hold a portfolio including Ethereum and Solana. Thank you.
All right, so before we end the day, I have a double-barreled question for you. The first one is the Ether price volatility, is there any relationship between inflation and Ethereum price? That's the first question. And the second question is, what are your key takeaways for the members of the audience today?
Okay, first question. Inflation. I assume we're talking about the the financial market, the actual inflation we're talking. Sorry, we are facing now,
Yes.
right? The prices are going up.
Correct.
Okay. Well, I have to say, unfortunately, when Bitcoin was first invented, or when crypto market first came to the public, right, many people believe that this is going to be the ultimate inflation hedge, right? Because the whole point of Bitcoin's invention was that when the central banks basically opened their floodgates to start QE and print money without limit, right? So Bitcoin had this characteristic like gold, okay? But unfortunately, from the data that I can see, right, especially nowadays, with inflation numbers printing very high, like the CPI is going to I don't know 6-7% in many of the countries, right? Especially in Europe and US. If the entire crypto space, including Bitcoin and Ethereum, is actually under some very big pressures, right? But it could be due to several reasons, right? It could be due to, let's say, December was the end of year, so a lot of institutional investors actually had to close their books, right, to get their numbers marked, to get their bonuses, right? So that's a typical behavior of institutional investors, right? By the probably at the beginning of the next year, they will slowly add back the risk, right? So that could be one of the reasons. Another reason is that because of the hawkish stance of the Federal Reserve and some of the other central banks, right? So they have finally retired these words transitory to describe inflation, which means now they see this is a big problem and they have to do something about it. So they are not only tapering at a faster pace, but they are also talking about maybe hiking rates for 3 or 4 times even this year. Right, so this is going to simply put, it's going to strengthen the US dollar probably, and it's going to drain the liquidity out of the financial market, because the US financial condition has been the loosest in I don't know, maybe half a century. Right? So Fed has to tighten this financial condition. By tightening the financial condition, that means the liquidity, some part of the liquidity is going to get out of the system, right? And in that scenario, I don't think that the cryptos is going to be unharmed, right? It will be like a collateral damage when the liquidity drains out, right? Because when you need liquidity, you basically sell everything you can to get cash. Okay, but this is only the short term. I would say the short term possible outcome. But in the long term, I think because of this network effect, because of this new technology, in the long term, I'm very bullish on this entire digital asset space. Yeah, but in the short term, even though inflation is high, I doubt, due to the reasons I said just now, I doubt that the cryptos are going to be a very helpful hedge against inflation. Thank you.
All right, and those are the words from the proprietary trader, Wan Zuhao, who's also the Chief Technical Officer for Synergy Link Capital and Inspirante Trading Solutions. Thank you so much for all your questions and the lively participation. We had so many questions, we couldn't go through all of them. And thank you once again. We'll do our best to get back to you on the questions that we could not answer. Once again, a big thank you to our guest speaker, Wan Zuhao.
Thank you. Thank you, Sri.
And
thank you, everyone.
Thank you for being a wonderful audience. Take care and stay safe. Do look out for follow-up emails coming your way tomorrow, and you can revise on what was covered today through the video recording. All right. So we'll share the link to the video recording so you can still catch up on what was covered. All right. That's all for today. See you in our next live webinar. Good night. Take care and stay safe.
Good night.